Good evening, folks. Welcome to our webinar tonight. It's been brought to you here by the advisory services in the Roscommon Longford region. My name is Shane Devaney. I am an education officer here in the Roscommon Longford region, and I will be your host for the night. The topics we're covering tonight are first topic will be the schemes update on acres, TANs, and on SCEP schemes. And the second topic which we'll cover tonight will um, be farm tax and recent changes in the budget. Just to let you know, this is our second webinar over the winter series, and this our next webinar, our third one, will be in the new year, and it will be on Monday, the 13th of January at 8 o'clock. So I'm going to introduce our two speakers who will be speaking tonight. Our first speaker is Donal McCabe. Donal is a Drystock Advisor, B&T Advisor in the Teagasc Longford office, and he will be covering the schemes update. And our second speaker tonight will be Kevin Connolly, who is a financial management specialist in Teagasc, and Kevin will be covering the farm tax and the recent budget changes. So just to give you, I suppose, the link to the webinar will be approximately 1 hour. Our two speakers will be allowed roughly 20 minutes each to speak on their topics, and then after that, we will have a question and answer session, which will be managed by Michael Conroy. Michael will be doing the questions and answer session. Michael is a sheep and drystock advisor here in the Roscommon office in Teagasc. There will also be a video recording of this webinar tonight, and if you want to view that, you will be able to get it on the Teagasc Longford Roscommon YouTube channel, and you'll also get it on the links associated with the social media. Okay, so no further ado, I'm going to introduce our first speaker, which is Donal McCabe. So Donal, if you can start to share your screen there and start your presentation, please.
Right, so look, good evening, everybody. As Shane was outlining, I'm just going to cover the schemes update. Now, look, I kind of picked three schemes that would generate a lot of questions. And look, I suppose you could spend a day nearly speaking about each of them. So what I've done is I'll just try to condense it down into the questions that I would get asked fairly often, and just what I think myself is kind of most relevant at this time. So look, we'll just start with the acres scheme. And now the acres. So for those of you that tuning in that are in acres, you're either in tranche one or tranche two of acres. So, like the farmers that are in acres tranche one, so that was the first round of applications for acres. If you're approved into that, you're currently coming to the end of year two of your 5-year term in acres if you're in tranche one. If you are applied on the second round of applications in tranche two, you're only coming to the end of year one. So it's a 5-year scheme. So look, you either have 3 years or 4 years to go, depending on which tranche that you're in. The payments in respect to 2024 have commenced. Now, I think they've commenced primarily to tranche one participants at the moment. Tranche two participants, they're due to be issuing this week, to the best of my knowledge anyway. So, look, there would be a couple of farmers even in the would have to receive their balance in payment in respect of 2023 yet due to computer IT glitches and just other little issues in the processing of their applications. But look, the department, I suppose they have made good progress on those in the last couple of weeks. So hopefully, if there's any of you listening that are in that boat that are still waiting on part of 2023 payment, that should be paid hopefully soon. I just put together just some common questions that I get asked quite a bit every year, just in regard to acres. The extensive grazing. So, can you graze extensive grazing all year round? The answer to that question is yes. So, cattle and sheep can graze the extensive grazing at any particular month of the year. The only thing is, if you're not allowed to supplement cattle with fodder, with hay or silage on the extensive grazing. Sheep, you are permitted to give them hay, provided they're not doing much poaching. But with cattle, there's definitely no ring feeders allowed or any supplementation of forage allowed on the extensive grazing. Meal feeding is permitted as well, provided that you move the troughs regularly and that again, that you're not causing much in the way of poaching. The geese and swans action then, geese and swans was another popular action for farmers that could avail of that action. Now your area had to be mapped in a geese and swans area to allow you to avail of that action. But for the farmers that were mapped, had geese and swans area mapped as part of their land and who chose that action, the grazing dates for that is you're not permitted to graze that ground again until the 1st of April. So it's the 1st of April to the 30th of September each year in terms of when you can graze that ground. So obviously the other 6 months of the year, it has to be left to the geese and swans. And just another common question is what are the requirements in regard to the acres riparian zone? And there's just a little bit of confusion at times in terms of when that area can be topped or if it can be topped and when it can be topped. And you get one or two questions as well in terms of can you allow stock on it. So cattle or sheep or any stock can never enter the acres riparian zone at any time of the year. So just not to get mixed up on that one because that would be a fairly serious offence and there's a lot of money obviously riding on that particular action. So you just want to be careful in regard to that. In regard to the cutting, the easiest way to remember it is you can top or mow the riparian zone whenever you can cut hedges. So from the 1st of September up until the end of February. That's when you're allowed to top your riparian zone. So again, any time outside that, it has to be left alone. And just to make sure that it's stock proof as well. If an inspector comes out and sees a gappy hedge with no wire at the side of it, and that it's obvious a cattle could go into that area, even if they haven't broken in, but the inspector deems that they could easily break in, well then, you could be in line for a penalty there. So there has to be a fence alongside the boundary in the riparian zone. Look, particularly in adjacent to your own fields anyway. Just make sure it's stock proof. And then just another common question in regard to the low input grassland or the flowery grassland, as a lot of farmers will refer to it now. So it's the area that's scored for the wildflowers when you can top that. A lot of people, and look, you can understand the confusion in regards to it. When you're not dealing with it all the time, they're mixing up their low input grassland with their extensive grazing. The low input grassland is scored for flowers. So the more often that area is topped, particularly in the spring and summer, the more damage you may do to the flowers, and the less your score will be then as a result. And the less your score on that area, the lower your payment will be. So look, at technically speaking, you can top or mow the low input grassland anytime, but when your advisor comes out to score it, if they can't see flowers in the sward, well, and if there isn't an appropriate grazing structure there in terms of different heights of grasses, well, then your score will be hit and your payment will be hit. But like technically speaking, if your advisor was out scoring that area, we'll say for argument's sake, the 25th of June, there'd be nothing to stop you the following day then from going in and topping that area if you wanted to. If you're going mowing it for silage to avail of the late cutting bonus, it has to be mowed between the 1st of July and the end of August to qualify for that bonus. Um, but look, the answer to that question there is technically anytime. But look, ideally, definitely after the end of April, I'd be easing off on the top end because, until the field is scored, if it is going to be scored in that particular year, because as I say, you're only potentially hampering your score, which will affect your payment. Now, bear in mind too that a lot of, if your acre low input grassland was scored this year, it more than likely won't have to be scored next year unless you request it to be rescored next year. So, you just check with your advisor just in regard to that. But the answer there is technically anytime. Just in regard to, I suppose, some of the acres work that is required now, just the things that to keep in mind, at this particular stage of the year. So farmers in acres tranche one, they should have soil samples taken at this stage, hopefully. Um, their soil report should be uploaded on the Ag Food system by the end of the year. Now, in most cases, that will be the advisor that will do that. And you can check with your advisor just to make sure that that's done for you. Some farmers that will be very proficient on the computer, they may wish to do that themselves, and obviously that's fine too. But just to make sure that the soil report is uploaded by the end of the year. If you're in tranche two, you have that a little bit longer because obviously you joined the scheme later. So if you haven't soil samples taken since the 1st of January 2022, just make sure and get them taken over the winter. And then that subsequent soil report that will be generated from that needs to be uploaded by the 15th of May of next year. So again, that's another important date to remember because balance and payments could be affected, and indeed your participation in the scheme could even be called into question if that isn't adhered to. So just be mindful of that. And so for soil samples to be eligible, they have to be taken since the 1st of January 2022. So if you have soil samples taken before that, they're still in date because they last for 4 years. Let's say if you had them taken at the end of 2021, they're still in date, but they're not eligible for acres because they're out, they're before that 1st of January 2022 cut off. Just other things to be very conscious of as well. Some farmers in tranche one, they would have ticked the box to say they're availing of the rare breeds action. So that could be your Connemara ponies or your Galway sheep or your Dexter cattle or whatever the case may be. If you haven't done so already, you need to make a return to the department in respect of those by the 31st December 24. So if you think you are availing the rare breeds action, yeah, you haven't been in contact with your advisor in regard to the submitting of that rare breed claim, you need to do so ASAP because that needs to be made by the end of the year. Also, farmers availing of the low emission slurry spreading action. So, look, even today I was in contact with one or two farmers that I haven't heard from in regard to that action. The paperwork in regard to that, well, paperwork, it's an online submission that needs to be done by the 31st of December as well. Again, look, with that return, there are a couple of farmers that will take it on themselves to do it, and that's fine. But look, as I say, if you don't feel confident doing that, just contact your advisor and they'll sort that for you. An important point to note is no payment will issue to you if you're availing of those actions, but you haven't made your return. So if you're waiting on your acres payment and you haven't, done what you needed to do in regard to those actions, if you pick them, you'll be waiting a long time because the department aren't going to pay out until those actions are fulfilled in respect to this year. Just in terms of tranche one participants, I'm hoping most of you tuned in are okay in regard to that. But in terms of tranche two participants, and again, most of you should have this sorted at this stage. But if you haven't, you need to complete your acres training course by the end of the year. So that's, I know the courses are thin on the ground now because most of them have taken place, but there are one or two yet to be held around the country. I know with Teagasc, to the best of my knowledge, there's two that I could see up on the system there that is left to run. But look at, hopefully most of you are sorted in regard to that. But if you're not, just as I say, you'd want to get on it ASAP. Okay, so that's a little bit on acres. And again, look, I'm conscious that I could be putting up points that might, they mightn't be necessarily questions that you'd ask, but obviously now is your chance. If you just put them in the Q&A tab, I'll do my best to answer them towards the end of the webinar. So just in regards to TAMS then, just to give you a rundown on that, I suppose just to explain how it works, because a lot of farmers just aren't kind of conscious of how the whole TAMS operates, and they hear of a deadline and they're kind of panicking then because of this deadline and think that, look, if they're not in by this deadline, they'll miss out altogether. But TAMS operates via tranches. So they're essentially windows for application. So the fifth tranche of TAMS 3 actually closed just Friday gone, the 6th of December. And the next tranche would usually open up the next day. So typically speaking, when tranche 4 closed, let's say for argument's sake, TAMS 5 would open up the next day. But the department are doing some background work in regards to the new nutrient storage grant, which I'll talk about briefly now in a couple of minutes. And they've actually closed down the system for submitting applications until the 9th of January. You can still prepare applications, but you can't submit them until the 9th of January. That tranche will remain open for applications until the 7th of March. So essentially, what will happen with applications submitted and at any stage during a tranche, none of them are looked at until the tranche is over. And then when the tranche is over, the department will start processing those applications then. Approvals usually start issuing approximately 3 months after the tranche closing date. So anyone that submitted a TAMS application by Friday gone there, 6th of December, hopefully, you should start, the approvals just should start to come in respect of that tranche, around about next March. That would be the plan. Obviously, if you're in this tranche that will open for applications for submitting applications on the 9th of January, it's closed on the 7th of March, so it'll be likely June before you get approval in regards to that. Just a couple of points in regards to it. So for any fixed investments, a copy of the land registry folio is required at the claim stage. So again, look, if you're putting up a shed, if you're carrying out even replacing slats or any fixed investment, you will need a copy of the folio. So just be mindful of that. The folio will have to be in the name of the applicant as well. If you're leasing the land, the lease must be in place for 5 years from when the date the claim for payment is submitted. So it's not 5 years from when the application is submitted. So it's when the date for the claim is submitted. So when you apply, you'll hopefully get your approval. You carry out your work, then you submit your claim for payment after you've finished your work. And it's from that claim date, the date the claim is lodged with the department, that's when the 5 years have to run from. Farm safety training course is also required to be submitted with the claim for all TAMS grant aided investments as well. So look at the half-day course. I know we do run them in the Teagasc offices across the region. So look, if you want to be in the pot for that, you could just contact your local office and they'll put you on a waiting list in regard to that. They can be done online through other providers as well. It doesn't have to be done with Teagasc either. So in terms of any new slurry storage facility or any new sheds, prior to applying for the grant, you will need to get planning permission or planning exemption. So even if you don't need planning, you'll have to get that written approval from the council to verify that you don't need planning. So again, just to be mindful there, because nothing can be done until that box is ticked. The application will be rejected if there's no planning permission or planning exemption submitted with the application. No fixed investments can commence until approval is granted. So you have to wait for your approval for any fixed investment. So look, a fixed investment, I suppose, is something that's fixed into the ground. So like a shed is a fixed investment. You're not going to be moving anywhere. Replacing slats is a fixed investment. Even fence posts is seen as a fixed investment as well. Because you're not going to be, in terms of the grant aided fencing, you're not going to be lifting up the post and wire and moving it somewhere else, timber post and wire. So that's a fixed investment. So anything that's fixed, that can't commence until approval is granted. Mobile investments, so a mobile handling cattle unit, a weighing scales, a head scoop, they're all mobile investments that can be moved from A to B. You can purchase those items when you make your application, so you don't have to wait for approval. Generally, it's advised though to wait for approval because if there is an issue with the application and it's rejected, the thing is up in the air then because you've essentially bought something that you didn't get approval for. Now, look, it depends on the person. Some people will say, well, look, I need this now. I'll take my chances. I've made my application. I'm going to purchase my head scoop for argument's sake. But look, there is a certain element of risk in that. Because look, your application, there's every chance and a very good chance it is going to be approved. But look, you just don't know for sure. But just that technically speaking, you can buy it after you apply if it's mobile equipment. The rate of grant aid paid under terms is either 40% or 60% of the department costings, the department reference costings, or 40% or 60% of the receipted costs, whichever is less. So again, the department of costings on everything that they provide grant aid for. So, whatever, when all your work completed, the grant that you get is going to be, we'll say if it's a 60% grant, it's going to be 60% of the department costings or 60% of whatever it's going to cost you, whichever is less. Okay. In terms of the limit of the costings, it's typically 90,000 per applicant. In the case of registered farm partnerships, that can increase to 160,000. Now, if it's under the Young Farmer Capital Investment Scheme, the difference between the 90,000 and the 160,000 is payable only at 40%. So you won't get 60% of 160,000. It's 60% of 90,000 and then 40% of the remaining 70,000. For less applications, a limit on the costings is 40,000 under a separate ceiling. So by less applications, what I mean is low emission slurry spreading equipment. So let's say, for argument's sake, a new tanker plus a trailer and shoe, that's the max that the department will grant aid under that particular investment. Just something to be very conscious of as well, because particularly, look, if a farmer, the farmers can do this themselves. There's obviously no issue with them doing it themselves. But an odd time you'd hear of a farmer that would get into bother because they might be looking for something small, let's say a head scoop, and they're not conscious of the minimum spend. So in order for the department to process your application, you have to be proposing to spend €2,000 in terms of the reference costs on the system. So if you just put in a head scoop, it's going to fail because the reference costs on that, I think it's somewhere less than €500. It's a long way shy of 2,000. So it's not going to get past the checks. It's going to be rejected. Let's say if you intended to buy a weighing scales and the head scoop as well, if it goes over €2,000 in terms of your proposed spend, even if you change your mind or didn't go ahead and buy the weighing scales, there's no issue there. You can just claim your grant on the head scoop. But your proposed spend from the start, it has to be a minimum of €2,000 to pass the check there. Look, the 60% rate of grant aid, I just listed them there. The Solar Capital Investment Scheme, Farm Safety Capital Investment Scheme. So that's your cattle handling equipment, your weighing scales, your low emission slurry spreading. There's 60% rate of grant aid for all farmers in respect of that, but you have to be using the trail and shoe now. The dribble bar is gone. Organic Capital Investment Scheme, the Women Farmer Capital Investment Scheme as well. So to be eligible without a level 6 qualifications here, Green Cert, the applicant must have submitted a 2022 BPS application. So it would have to be a woman farmer on the 2022 BPS, and you have to be younger than 67 years of age at the time of application as well. But there is, to encourage, I suppose, female farming participation, there is that extra rate of grant aid there for women farmers. Young Farmer Capital Investment Scheme must be less than 41 years at the time of application. So note in the case of joint ventures, only registered farm partnerships are eligible. So joint herd numbers, they're not, on joint herd numbers on their own aren't going to be eligible for the extra top up. Just be conscious of that because some farmers could get caught there. Even if it is a young trained farmer, if it's only a joint venture and it's not a properly registered farm partnership, well then they'll only be getting 40% in terms of grant aid. They won't be getting 60%. Obviously, if it's a young farmer on their own, that's not an issue. There's the 40% of rate of grant aid for TAMS. So you have your the schemes there: Animal Welfare Nutrient Storage Scheme, Dairy Equipment Scheme, Pigs and Poultry Investment Scheme, Tillage Capital Investment Scheme there. In the spring, or possibly look at late winter, we're not sure yet, there will be a 60% grant for nutrient storage investments. That's proposed to be brought out as well. was announced in the budget previously. There's no terms and conditions for that yet, but from what I'm hearing, it's anticipated that existing TAMS rules will apply in regard to the planning permission requirement, obviously, and that you have to be nitrates compliant to apply for that extra storage. So if you're not nitrates compliant, you won't get a grant to become compliant. You have to be, you'll get a grant, I suppose, to go, in terms of what your future plans are, but you won't be getting a grant to become compliant by the looks of it. Look, there are just some popular investments in TAMS. Look, I'm not going to list them all there. You can see them. Your scales, your cattle handling facilities, fencing, bovine and sheep fencing. There's cattle fencing in there now. Farmers, a lot of them are only becoming aware of that now. That's beginning to get a bit more popular. Meal bins, replacing slats, and look, lots more investments. If you consult the Department of Agriculture website, so Google Tam Street Department of Agriculture, you'll be able to bring up a whole list of investments there. Just one slide then on SCEP, because I know I'm over time, I'd say, at this stage. In terms of SCEP, just a few reminders there in regard to this scheme. So calve at least 50% of your reference number each year. That's very important. If you calve less than 50% of your reference number each year, you're gone from the scheme. You'll actually be kicked out of the scheme. And any monies you were paid would have to be repaid back. So be aware of your reference number. And if you're scaling back in terms of your cow numbers, be conscious that you don't scale back less than 50%. You can reduce your number gradually over time. And again, your advisor will advise you in regards to that. But that 50% is a very important point to note there. 80% of calves born each year must be from a 4 or 5-star bull. 65% of the reference number must be 4 or 5 stars on the replacement index. So this is the female end of things now, the heifers and cows, by the 31st October 2025. So the heifers, to be counted for that, must be at least 16 years of age on that particular date. All calves born in the holding must be retained for at least 5 months in order to complete surveys. And my very last slide on the surveys, the deadline for completing surveys is the 15th of February each year. So that's the 15th of February coming, for in respect of the current year we're in now. Every year I see farmers leaving money come behind them because they haven't completed those surveys. Rather than waiting for the forms in the post, by it far and away the easiest way to complete the surveys. Now, granted, look, I know everyone isn't computer literate, I accept that, but on icbf.com, now with the limited space I had, I just put in a kind of a view of the screen there, if you log into ICBF, what you will be facing, if you're a SCEP participant. And it gives all the different surveys that are required there in a bar chart going across each of them. So you click on the bar chart and you fill in any outstanding information. If those bars are fully across the screen, like what they are in this here, it means you've answered all the surveys and you're not going to be leaving any money behind you. But if you're waiting on forms and forms potentially getting lost and before they get to the post or in the post or whatever, as I say, there could be money there going a begging because you mightn't have all your surveys recorded. So look, I would encourage everyone, if you can't do it yourself, maybe look, try and get help with it, and just go on to icbf.com. And if you don't know your password, if you've forgotten your password or don't know what it is, if you text pass to that number up on the screen there, your username and your password will be texted to you. So look, I know that's a very quick run through all the schemes. Look, I'll do my best to answer any questions that you may have later on. So look, Shane, I'll hand back to you at that.
Thank you, Donal, for a very comprehensive and a detailed presentation, and some very useful advice for a lot of the people logged on here tonight. So thank you for that. Just to mention, there is just to remind you, the Q&A tab there at the bottom of your screen. So if you want to type in your questions there on that, and nobody else can see your name if you're worried about that or what you're typing up. So look, if you want to, this is the place to ask the questions tonight to the two speakers. So don't be afraid to put up any questions you might have on your mind. So what I'm going to do now, I'm going to go over to our second speaker, Kevin. So if you can get ready, Kevin, to share your screen and get started your presentation.
Hopefully you're able to see that there now, Shane.
Yeah, Kevin, that's up there. Good to go.
Good stuff. Good stuff. Thanks, Shane. Hello, everybody. A bit like what Donal has given you there, this is going to be a very quick run through some of the recent changes that that took place in the budget just gone there in October and the following finance bill. By way of trying to explain this, I'm going to basically talk through how these changes affect the calculation of somebody's tax bill using an example. And I'm going to be using 2024 information for this, as we're still currently in this tax year of 2024, and that's how your next tax calculation is going to be done. But the budget just gone announced the changes that are going to happen for the 2025 tax year, and I'm going to refer to those as I go through this and just give you a bit of guidance as to what impact that's likely to have when that kicks in the 2025 tax year. So the calculation basically starts off with taxable income, and this is a taxable income for a married person, but there's only one income coming into the household. So this taxable income that starts off the calculation is basically what your accountant would prepare using your tax accounts. So they take all the information from your sales, you know, the likes of some of the direct payments there that Donal was referring to, the likes of acres and so on, and BIS payments on top of your sales, whip off any expenses you have, make a few other adjustments, and that comes to a figure of your taxable income for that year. And so once you do that, then you're down to kind of then looking to see, well, how much of that is taxable at the various rates. And this is the thing that a lot of people look to when they hear the budget announced. You know, is there any changes in the rates, or is there any changes in the bands? Each individual taxpayer gets access to a standard rate band based on your individual circumstances, and this band basically sets the cutoff point of how much your income is going to be taxable at the standard rate, as it's called, which is essentially the lower rate. And at the minute, the lower rate is 20%. And anything above that band or that cutoff point, that's what's hit then with the higher rate of tax, which is currently at 40%. So in this case, in this particular example, we're going to be looking at an individual that's sitting around here, married, one income. So that the tax band, standard rate band for 2024 was 51,000. So once they cross 51,000, that's as much as they're going to get at the 20% rate. Anything over and above that is going to be hit at tax at 40%. The good news then for the 2025 tax year is that standard rate band increased by 2,000. So it's moving from 51 to 53 for that particular category of taxpayer. And you can see all the other different categories then, they all kind of move up in line with that. So what that essentially means is it's taken that €2,000 out of the tax calculation at 40%, and it's now going to be calculated at 20%, but for the 2025 tax year. So if we go back to our example again, we started with the 53,000 of taxable income, and using the 2024 bands, the first 51,000 of that, if you remember, is going to be hit at tax at 20%, and that's what it calculates out as, 10,200, and then that leaves 2,000 then remaining to be taxed at the 40%, and that's what it comes to, given a total potential income tax bill at that point of 11,000. But doesn't stop there, unfortunately. You can see a bit of blank space at the bottom there, so there's a lot more calculating to be done. And the first thing, luckily enough, is a positive thing, because there's, at this stage, everybody gets a set of what are called tax credits. And this acts as a deduction against the potential tax bill. And these credits basically you can maybe make use of more than one set of these credits, and they depend, or what you can get available or get access to depends on your own individual circumstances. And this is just a range of the credits. It's not them all, but just a selection of them. And you can see both the credits for 2024 and 2025. And again, you can see the good news there is that the credits all increased as well for 2025. Most of them kind of rounded up to nice round figures there to around 2,000 for single credit, double that for a married person. So those credits act as a deduction off your tax bill. So again, flicking back to the calculation again, this particular individual gets access to two credits. He gets the personal tax credit and the earned income tax credit, which is for all self-employed people. get a credit there. The personal tax credit is the married one, and that's 3,750, and then you have the earned income tax credit then of 1,875, which gives you a total deduction of 625, and that comes off the 11,000, leaving a net 5,375 euro. It'd be great if it stopped at that point, but unfortunately, there's a couple of other taxes then that kick in at this stage, and they're all regarded as part of the income tax calculation. The first one is PRSI, peer-related social insurance. All self-employed people, farmers included, pay Class S PRSI, and the rate of that is at 4.1%. It went up to that from the 1st of October last on farm income for 2024. It's actually going to go up by another 0.1% in October 2025 again, and it's going to continue to increase on up in the years after that. It's applied to all income. There's no bans in place for PRSI, and these PRSI contributions, as they're called, they were often called stamps in the past. Basically, they confer some bit of entitlement to get something back. The thing about these is they are linked to you actually getting some benefit back, either currently or in the future. And I suppose the main thing that people associated with these is the non-means tested social protection payments, the likes of the contributory pension. If you clock up a certain number of stamps, PRSI contributions over the period of your working life, that entitles you to a full contributory state pension. So that's a useful benefit in making those contributions, and you will get certain other benefits as well, the likes of dental benefit and so on, and optical benefits, by making those contributions. So the other one then that kicks in at this point is the Universal Social Charge, or the USC, and it, again, a bit like PRSI, it applies on all income, but there are bands there. There are different kind of rates depending on where you hit or at what level of income you're at. There's so much at a given level of income, and then it starts to increase. It's known as kind of a progressive tax rate, if you like, because it increases as the income increases. Now, again, you'll see there, I have both the 2024 and the 2025 rates and bands shown here. And there were bits of changes to both the bands and the rates, and positive changes at that. You can see there, I just pointed out to you, you have at the 2% rate here, the band actually increased by around 1,600 euro, or a little above it. So there's a little bit more of your income being subject to that lower rate at 2%. And then the next band above that starts off then at the cutoff point for the 2% and goes up as far as 70,000. And that particular band there, actually, the rate that applies to it has dropped from 4% to 3% for the 2025 year. So that's a positive too. It's taken some of the heat or some of the pain out of the USC on individual taxpayers by making those adjustments. But it's for the 2025 year. So if we go back to our calculation again, the PRSI goes on, so it takes the full 53 and applies the 4.1% to that, given a PRSI calculation of just over 2,000. And then it starts working through the different bands of USC at the different rates for 2024, and calculates out what the USC is. Add those two together, both the PRSI and all the USC together, and it comes to another just short of 3,600 of tax there. And when you add that all up, or add that onto your net income tax liability, you come to the total tax liability on the basis of that 53,000 of just shy of 9,000 euro, which is an effective tax rate, basically expressing that as a percentage of the 53,000 of 17%. If you were to apply those same figures, or take that same level of income and shoot it forward into 2025 and make, those adjustments that I said, were made in the budget as regards the bands and the rates and the various different changes right down along the line, what difference would that make? Well, essentially, that particular tax liability would be 1,000 euro lower again. So it would drop down to 15% of an effective tax rate. So that's, I suppose, there's a lot of talk in the budget and a lot of individual changes and tweaks here and there made on it, but you can see that the changes made in 2025, when they do kick in, they should result in lower tax bills on the same level of income. So just to change tack then and look at some of the other things that are normally announced around budget day. I've been talking about income up to this, but particularly in a farm situation and a farm at a certain stage, they're interested in handover of the farm and handover of the business, and usually the assets of the business. And we all know that there's certain tax implications in doing that, and everybody always kind of keeps a good eye on the budget to see, is there any changes in some of these capital taxes that affect the lifetime transfer of farm assets. So there were a couple of little changes around these, and I'm going to just go through some of the basics on them now, and I'm going to look at it from the point of view of both sides, both the person that's doing the giving, that's currently the farmer, the outgoing generation, if you like, and they're looking to hand over, and also look at it from the point of view of what these changes or potential changes might mean to the receiver, and the taxes that apply. And you can see there's the different taxes, and I'm going to go through some of these and some of the reliefs, because it's the reliefs is really where some of the changes really start to kick in. So the first one is on the giver side, or the person handing over, and the main tax that they're interested in all the time is capital gains tax, and the main relief they'd be hoping to avail of is this relief called retirement relief. So first of all, if we look at how capital gains tax works, and just to point out that this example I'm going to show you, this is a kind of a worst case scenario if there was no reliefs in place, and no reliefs that could be availed of. What potentially could a capital gains tax bill look like on a given transfer? So if we take an example of a block of land that was at some stage in the past acquired, maybe by gift or maybe by an inheritance from a family member, or possibly even purchased, and it was bought or acquired at a value of, say, €90,000 at that point. And at this stage, then that same 25 or 27 acres is looking to be handed on, gifted, or maybe even sold on to a third party for a value of 220,000. Well, essentially what this capital gains tax does is it taxes the lift in value, the gain in the value from when you initially acquired that particular block of land to what you're actually getting for it now when you dispose of it. So if you take the 90 from the 220, that's essentially a lift in value or a gain of 130,000. And it's that's taxed at the capital gains tax rate, which is currently 33%. And if you work out what 33% of 130,000 is, it's €42,900. So it's a fairly substantial whack of tax to take. And look, most people can get their heads around if you pay that bit of tax on a sale, you have the money. You mightn't like handing it over in tax, but you have it there to pay the tax bill if required. But if you're gifting land on to somebody, a family member, most people just couldn't afford to take the hit of 43,000 in that case, where they're not getting anything back from it. But the good news is, particularly in relation to business assets, that there are reliefs available, and it's important that everybody would check and don't take it, take this as an example of, geez, I can't do anything as regards handover because there's going to be CGT. There's reliefs there available, and this relief that I'm going to talk you through is the main one that most people avail of. Retirement relief from capital gains tax, very, very widely used relief and very valuable relief. I suppose the name is a bit misleading. You don't actually have to retire from farming in order to avail of this relief. It could be that you are retiring from farming and you're handing over everything, but you may wish to still remain farming, still remain actively involved in the farm while not having ownership of the land, or you may want to hold on to a bit of land in your own right and still farm away at it. You can still avail of retirement relief in those situations. It's not a condition that you have to stop farming completely in order to avail of the relief or hold on to the relief. But there are conditions associated with it. The main one that people need to be aware of is there's a minimum age condition. You have to be a minimum of 55 years of age in order to avail of the relief. That's 55 at the point that you're actually doing the transfer and wishing to avail of the relief itself. And I suppose that the main one then is this one here about ownership and usage. You must have owned the land or owned the asset that you're going to hand on, and use the asset for the purposes of the business, the farming business, for at least 10 years. So you must have owned the land and used the land for at least 10 years in order to be able to claim retirement relief on its transfer. So that's an important one. And look, I could spend a good while talking through the ifs, ands and buts in relation to that, but it's something definitely to check with your accountant if you're in a position where CGT could be an issue for you and you're hoping to avail of the relief. Just make sure that you can show that you have owned that land and used that land continuously for the previous 10 years. There is conditions also imposed on the person receiving the land as well, usually by gift in the case of a child. And if they don't retain the assets after the parent has availed of retirement relief, the child must retain the assets for at least 6 years to avoid clawback of the relief. And by clawback, I mean the actual relief is withdrawn and the tax bill that would have originally been charged now becomes liable, and it's liable now on the child. So it's in their interest to make sure that they hold on to that land, retain the assets for at least 6 years. If it was a case where anybody listening in had assets over 10 million, there's also additional kind of rules and conditions associated with that. They were brought in last year and they're coming into effect now on the 1st of January. So that 12-year clawback period is in place. But 10 million, I don't think there's going to be too many farms anywhere in the country that's going to fall foul of that. Might be a few, all right, and they may need to watch that one. The limits, I suppose, there are different levels of this relief and how it works, depending on the age of the person, the disponer, as I call them here, which is the person doing the giving, their age at the point in time when they're actually availing of the relief. And so the limit varies based on age, and it also varies based on the relationship to who they're giving the assets to. The highest levels of retirement relief are available where assets are handed over to children and where the person doing the handing over is less than 70 years of age. And that's a change that's actually coming in from the 1st of January. That cutoff age was actually lower than that at 66 years of age up until the end of this year. And then we have that, I suppose, the limits, and these are limits on the actual value of the assets handed on. There's an upper limit there, as I said, of 10 million for children. There used to be no upper limit there where the assets were handed over less than 70 years of age. And in the case if it's over 70 years of age, there's an upper limit there of 3 million. It drops down considerably, and that will catch, I suppose, some farms there that have big tracts of land and a lot of land, maybe and high value land could be caught there. Once you go outside the children then and you're talking to anybody else other than a child, or if it's sold to a third party, then the limits drop substantially that you can avail of relief. So you're talking up until the age of 70, 750k, dropping down to 500,000 then once you cross the age of 70. So that's retirement relief. That'll look after the majority of people actually in most situations where family farms are transferred, but you just need to make sure some of those conditions, and don't take it as a given that everybody will avail of it. It's important to talk to your accountant and get that checked out. On the other side then, the person receiving, two taxes they need to worry about: capital acquisitions tax and stamp duty. Very quick run through these. Capital acquisitions tax is applied on the person receiving, as I said, and it applies in the case of, the rate of it is 33%. CGT, capital gains tax, which I was just finished talking about, and CAT, both at 33%. They tend to track each other. If one goes down, the other kind of follows, and one goes up, the other follows. They've been at the 33% rate for a good while now. There was a rumour that rate was going to drop in the budget, and it didn't. We'll wait to see what happens next year. Capital acquisitions tax applies on both gifts and inheritances that are received by the transferee, and once the gift is what defines a gift is where the transfer or the person doing the giving is still alive. If the person that's doing the giving is sadly passed away, then it becomes an inheritance. From a point of view of CAT, it doesn't make it any difference because they're still subject to the same tax and at the same rates, and it applies to the total value of the buildings and the land received, and any direct payment entitlements and any other assets received where they're not paid for by the transferee, and that's what CAT applies. Now again, luckily there are tax-free thresholds and there are reliefs available, and the main, I suppose, thing that most people look to in the budget is in relation to the thresholds. every transferee is entitled to a tax-free threshold, and it depends on the relationship to the person giving them the asset, giving them the gift or the inheritance. But the thing about it is there are lifetime thresholds. So within that particular category, in the transferee's lifetime, they only have a fixed amount of money to play with tax-free. And once they use that up, then anything over and above the threshold then suddenly becomes taxable. Good news in the budget in October and the finance bill that came afterwards kind of clarified that the thresholds have actually increased, first increase in a while, and they've gone up to nice round figures now. Up until the 1st of October, there were the threshold for the Group A threshold for where a son or daughter receives an asset was 335,000, and that's moved up to 400,000. And all the other groups then kind of followed suit, went up by a little bit, kind of matching that. So the new thresholds now, which are currently in place, that came in the day after the budget itself actually, are 400,000, 40,000 and 20,000 then for any other person. But I suppose the main a lot of people might be interested in is the 400,000 one. So that's increased, and that's definitely a positive. The other thing that you combine those thresholds with is then the main relief for CAT, which is agricultural relief. And this is an extremely valuable relief because it actually reduces the value of the assets that you receive down to 10% of their value. So it's an extremely valuable relief, and it's specifically looking at transfers where farms are involved. And it's the thing about it is while it's valuable, there are certain conditions. All these reliefs have conditions with them. There's 2 tests with them: a financial test looking at the value of assets, and there's also an active farmer test as well. Quite a bit of controversy around the budget when it was announced first, because these 2 tests or these 2 conditions have been around a number of years now in relation to the person receiving, but they actually proposed to bring in an active farmer condition on the person doing the giving as part of the budget. And that caused quite a bit of controversy, because there would be some situations where people wouldn't have been actively farming up to the point where they were doing the handover, and that could maybe rule out the person receiving the land from being able to avail of agricultural relief. After a bit of a period around the finance bill, that was decided to be put on ice for a while, and it'll probably stay that way. It definitely will stay that way at this stage until the new government is up and running, because it requires a ministerial order to be put into action. So until the new government is formed and the issue gets to be thrashed around in the Dáil for a while, we're not going to see that currently implemented. So currently there's no active farmer condition in relation to the person handing on the assets either by gift or inheritance, but the active farmer condition is still there for the transferee, and there's also a clawback period there as well. And just to finish up then very quickly, the last tax then is stamp duty. And the main thing most people look to in the budget, stamp duties have been around for a while now, but the relief associated with it maybe has been around just as long. In relation to the transfer of farms, young trained farmer relief from stamp duty is one of those reliefs which usually has an expiry date after so many years, and everybody kind of waits in the budget just to make sure that it's going to be renewed again. And it wasn't. We still have another year left on the current tranche of 3 years, so it wasn't even mentioned in the budget. It's still available until the end of 2025. I would expect it probably will be rolled over at that point and on ahead for another number of years. The name gives it away. You have to be a young farmer, in other words, under the age of 35. You have to be trained and have your level 6, and you also have to have a business plan certified by Teagasc as well. That's one maybe some people mightn't always be aware of, but that was brought in a number of years ago. Not a big onerous job, but it still needs to be done. And the one thing I suppose that people need to be very aware of is that the person receiving it, if they claim that relief, they have to actually farm the land actively themselves for 5 years after they claim. So that if they do fulfill all those requirements, basically they'll get away with no stamp duty. So that's a very quick run through. There's a lot more information on those reliefs that I've talked through, and some background information on some of the changes and details on some of the on the way some of these reliefs operate up on our website. If anybody wants to open up their smartphone camera and scan that, it should take them into our section on our website dealing on farm transfers. Keep an eye out as well. We run kind of public events, these transfer in the family farm events around the country. We run 6 of them every year, usually in the back end of the year, kind of October time. Keep an eye out for those when they're advertised, if there's one close by you. If you are in the frame of mind that you're going to maybe do something as regards transfer in the farm, they're well worth going to get a bit of information. So Shane, I'll leave it at that.
Thank you, Kevin. For a topic that is very complicated and hard to understand, you presented it in I suppose layman terms, which made it a lot easier for people like myself to get a grasp of it. So Kevin, thank you. And look at just to remind you there, the Q&A tab is there at the bottom of the screen. We've a good few questions in already. So if you want to type in a few more questions there, we'll start going through the questions. So what I'll do, Michael, is you've been there behind the scenes looking at the questions coming in. So I will hand over to you, Michael, and you can start going through them then. Is that okay?
Okay, thanks very much, Shane. Good evening, everyone. So I suppose, look, there's a lot of questions after coming in on the Q&A tab. I'll sort of group them, or I'll as the presenter them. I suppose the first one, I'll give Kevin a bit of a rest there, let him take a drink of water. And Donal, just on acres, there's a few questions in there on acres. One is acres open to new applications?
No, unfortunately not. And just from soundings of the Department of Agriculture, it's unlikely to be open. You know, in the near future. You know, look, some people were just very unlucky in terms of timing, in terms of when they set up the farm. I know I have a couple of clients myself in that boat, but unfortunately, you know, there's often farmers that lose out in these schemes, and by the soundness from the department at the moment, it's looking like acres won't be reopened.
And then there's just another one there in relation to from someone that was on the webinar in relation to the rates of payment. Are they fixed, or are they going to increase, or what's the situation with them?
No, very unlikely to change. Look, I suppose the payment rates would have been outlined at the time of application, and I know, look at you know, it's a relevant point in terms of inflation and things like that. You know, costs going up, but look at I suppose, yeah. You know, the payments, they're set out at the beginning of the plan, and you sign up to those, and look, they're very unlikely to change up or down.
Okay. Kevin, one for you. I suppose you give us the good news that there's going to be a few pound more in 25 than there was in 24 in relation to tax. But I have one question here. Can someone that's working off the farm and also has a farm income as well, can they claim PAYE credit as well as employed off-farm credit as well? The earned income credit.
Yeah,
Can they claim on the double?
Yeah, the earned income credit came in a number of years ago because there wasn't anything there for somebody that was self-employed, like farmers that were earning their income in a self-employed situation. The PAYE credit had been around for a good while, and that was always a kind of a bone of contention with self-employed people, that there was nothing there for anybody that had just self-employed income. In the case of the person that asked the question, where they have both sets of income, whether they're working off farm and they're also you know, have a bit of farming income as well, can you do it on the double? Unfortunately not. You're limited to the €2,000 in case of the credit for 2025. So each of the PAYE and the earned income credit, they're both set at a max of 2,000, and that's the most you can get but between the two sources of income. So you can't double up on it, unfortunately. No.
Right. I suppose back to you, Donal. There's another one here just in relation to TAM, or in relation to acres. Are you allowed to sow some natural wildflowers in the headlands to improve your scores?
No, generally, look, natural wildflowers, it generally won't work for a number of reasons. Like number one, I suppose they have to be on the approved species list for wildflowers that we take into consideration when we're out scoring. But number two, look, I suppose the whole objective of that option, you know, and no more than what I was saying in regards to the topping, is to make conditions favourable for the wildflowers to grow in the first place. So if the wildflowers aren't growing there, it's probably for some reason, there's maybe too much nutrient in that particular area. It's getting cut too often, or whatever the case may be. So chances are, even if you did go to the bother of sowing the wildflowers there, they wouldn't grow. So look, the best way to get a higher score in that would be to make conditions as suitable, for to grow the wildflowers as possible. So low nutrients, and look, I don't have the grasses out competing them. But there's even if you don't think that there'll be wildflowers, in your particular area, or that's proved to be the case with the scorn, there's other ways to pick up marks as well, apart from the flowers. So it's just to contact your advisor and get familiar with those, and just make sure that you're ticking the box in regard to those to improve the payment.
And I suppose it's only a comment that basically, when will acres be index linked? I suppose that's one for politicians. It's not one for people that's just doing up the schemes. Like, that's a department.
No, it's a
department
comment.
requirement.
Yeah.
There's just one other one there in relation to, you said there, a farm or a field is scored. We'll say this year might be scored for 2 years' time again. If you have a department inspection, like, so basically someone says, oh, it won't be scored for 2 years, or I can do what I want on this. If you have a department inspection, can that change your scoring, or how is that viewed?
Look, it won't and shouldn't stop you from topping it and mowing it. Now, just bear in mind, obviously, the more topping that you do in that field, the more that you're going to hamper the flowers. But you're not expected to not top it on the premise that you may get an inspection. I suppose that's the main thing. Now, look, it all depends on what you do on that field. Like, obviously, you're within your right to go out and reseed that field technically, if you want to be technical about it. But obviously, if the inspector comes out and sees that you've reseeded the field, naturally enough, now you're not going to, the inspector will know there's not the likelihood of too many flowers in that particular area. So look treat it, I suppose, as you are treating it. Don't overtop it, but don't be necessarily holding off on topping for fear of an inspection. Really would be my advice there.
Yeah. There's another one here, Kevin, just, I suppose, in relation to inheritance. If forestry is forestry included for farm tax relief in an inheritance tax, and do you need to be a farmer for the relief? So basically, it seems to be, if forestry is your only, we'll say, and it's your only on the farm, is your only action on the farm.
Yeah. I suppose that's back to the two tests that I mentioned earlier around claiming agricultural relief from CAT if there's forestry involved. If you're actively farming the land, say in a livestock situation, you can clearly see there's farming activity there, and you have time to put in on an ongoing basis to run the farm. If the land if a large part of it is under threes in forestry, some people would be kind of wondering, is that regarded as active farming? Because in most cases with forestry, you plant the forest, and there's a bit of maintenance and so on associated with it, but largely you're closing the gate and looking in at it. But it's the activity. The revenue have said that they will. They know that the farming of forestry it's less labor intensive. There is a rule there around a percentage of a person's work and time that they use in normal farming activity to be able to quantify whether a person is actively farming or not. And that kind of works out at 50% of their working time, or 20 hours a week. Now, nobody would be clocking up on average of 20 hours a week if they, on forestry land, because as I said, it's largely kind of passive. You're looking in on it rather than doing anything actively with it. But revenue do give a concession in relation to forestry that it's still regarded as farming once it's actively managed on a commercial basis. So once you can prove, that you're going in and you're doing thinnings and you're managing the forest, or you're paying somebody to manage it maybe, but there is kind of active work being done on it, not necessarily or definitely not 20 hours a week, but it is being done on farmed as such. Then it would be regarded as eligible for agricultural relief, and would be coming in under that, and would be regularly claimed on forestry land.
Thanks, Kevin. Just one for you, Donal. Can you add an item on your TAMS application after the application has already gone in?
Okay, so you can't add add an item to the application that you have submitted, but you are permitted to make another application under that tranche. But just be very careful, like what I alluded to earlier. If you're making another application under that tranche, be conscious of the €2,000 minimum spend. So if it's only a small item, again, if it's not meeting the €2,000 minimum spend, that application will get rejected. So you can't add on to an application submitted, but you are free to make a new one.
There's just another one here. Someone who got planning permission for a shed and a tank 6 years ago claimed a TAMS grant on the tank only. Now looking to apply for the TAMS on the shed, and the planning permission is valid for 5 years, but it's 6 years ago since they got the planning permission. What is the situation with regards to that?
Yeah, so look, there's no issue in terms of, look, I would have had clients in the past that would have got grant aid for a tank and then, drew down that money and they then got grant aid for the shed then after that. There's no problem there. The issue, stumbling block there would be the plan permission. Because you were saying, Michael, 5 years is the period, typically for plan permission. So in that case, what the farmer would be best advised to do would be to go back to the council and to revise the plan of permission on that to make sure the plan of permission is still valid. Because if it goes into the department as it is, the department will reject it on the pre-checks because the plan of permission wouldn't be in date.
There was another question there, Kevin, I suppose in relation to someone who recently inherited a farm and qualified for agricultural relief. Now there's a farmhouse on the land, so I take it that was inherited along with the land. Can I do up the house and rent it out, or will it affect my tax relief? I'm farming the land on a part-time basis along with the day job. So basically they have inherited the land with the house and they want to do up the house now and rent it out.
Yeah, the definition of a farmhouse, once it's inherited along with land, it can qualify for agricultural relief as well, which I presume is what's happened in this case. And I presume that the person asking the question then is wondering, are they putting their agricultural relief in jeopardy by renting that house out? It's a bit of a grey area, that, to be honest with you. It's like there's an active farmer condition there, as I mentioned already in the previous answer to the previous question, where you have to be actively farming the land or show that you're actively farming. Now, when it comes to a house, if it's included as a farmhouse and you're living in that farmhouse while you're farming the land, there'd be no questions asked. Once you let that out, I suppose there is a danger there that revenue might say, well, it's no longer a farmhouse; it's kind of an investment property. But my understanding of the way it works, and I would encourage whoever asked the question maybe just to check this out formally, is that once you retain you must retain the house for at least 6 years, because that retention period is a key part of the agricultural relief. You can't dispose of any part of the either land or anything that you got agricultural relief on for 6 years. If you hold on to that house for 6 years, then I think you probably will be safe enough as regards the relief. But I put a wee bit of a health warning over just to make sure and check that out before you do anything. If you did get agricultural relief on it and got it reduced down to 10% of its value, that's a very valuable relief, and you definitely don't want to jeopardize that by doing something hasty. So make sure and get professional advice on it. My gut feeling is it's probably okay, but make sure and check it out.
Michael,
Just the other one there.
We have a couple more questions, I suppose. Is that just going over time a bit?
Right. Well, we just
you've another 2 or 3, is it?
Well, just that one, or Kevin, in relation to that, if the house is gifted later or inherited later, is it still eligible for the agricultural relief? We'll say the land is inherited now or is gifted, and then the house is gifted at a later stage.
No, it has to go along with the land in order to be eligible for relief. So if you give the land first and the house later, it doesn't qualify for relief. But there's a strange one there, Michael, in that it actually, if once it joins back up to the land again, then it becomes an agricultural asset for any future gift later on. So if you got something later on, that could be counted as of agricultural value. That house could be counted as agricultural value because it's part of the actual land itself, part of the farm holding itself. But at the point of transfer, you need to be very careful about the way that's done. Generally, for farmhouses to fully qualify for relief, they need to go along with the land that's associated with the farm, in order to qualify as a farmhouse and get agricultural relief.
That's it.
So
I think
one or
that's
two more, Michael, if you have them, and then we'll get there's questions still coming in, so look, we'll be here a long time if you can answer them all. So we'll get back to people afterwards. With some
well,
of the
there's one or
answers.
two specific ones, and
We'll go to them. Yeah, what?
If you will put we'll get back to you on an email with the answers. There's a few ones here. There's one there in relation to someone who lost their PIN, misplaced their PIN for SCEP. But when I go into the ag food and under the suckler, the SCEP scheme, I get a pop-up, so an unauthorized access. Why is this, Donal? Have you come across that, or?
To be honest, I haven't. Now look, they're probably getting that error message because the deadline for the SCEP training has passed. I think if my memory serves me correct, was the 15th of November. Now look, there could be a genuine reason there as to why the training was missed. There could be any sort of force majeure reason there. So look, I suppose if there is a force majeure reason at play there, the best thing would be to communicate with the department and just explain why they may be attempting to complete their SCEP training late.
That'll do. That's it.
That's
Sure.
it,
Anyone
Michael.
else? We'll get back to them if the contact is. We'll get back on with the answers to any questions. Okay. There's a raft of questions in there at the moment, Shane.
All right. Okay, Michael. Thank you for that, Michael. And you got through a lot of stuff there, and a lot of very good questions come in, and information has been given out. So thanks for that, Michael. I also want to thank our two speakers, Donal and Kevin, on two excellent presentations. And as I said earlier on, some very useful information was given out here tonight. I'd like to thank all our people who logged on here tonight for the webinar. And just to mention that we have a webinar, I said it earlier on, that our next webinar will be on Monday, the 13th of January, after in the new year, beyond 8 o'clock. Topics being covered that night will be fertilizer planning and changes to herd numbers. Brian Daly will be covering that. And then the second topic will be regulations on water quality, which will be covered by Kieran Kenny. Look, just on this is been recorded, as we said earlier on, and if you want to view this webinar, it will be up on the YouTube, the Teagasc YouTube or Roscommon Longford YouTube channel, and you'll be able to avail of it on that over the next couple of days if you want to look back on it again. And look, that's all. I'd like to thank everybody for coming on tonight. Take care. Have a safe and a happy Christmas, and good night to everybody.